Hello everyone and welcome back to my channel. In this lesson, I'll be sharing with you a counter trend strategy that is based on retracements. So, although we will be taking trades against the overall trend, this strategy has a high probability of success with a high win rate. I'll guide you through the entire plan step by step. First, I'll provide you with a mechanical method to determine the bias. I know a lot of traders struggle with that. Then I'll explain how to confirm that bias. Then we will proceed to the lower time frames to look for entries and execute our trades. Additionally, I will discuss the times when this strategy performs best. I will also provide many chart examples and walk you through them one by one, demonstrating how to apply the strategy without errors. So, if you are interested in that, then stick around till the end of this video, and don't forget to hit that like button and subscribe to the channel so you won't miss any upcoming videos. And let's get started. So, the structure of this video is going to be as follows. First of all, I'm going to give you an abstract level or an overview of how this strategy works, right? What is the logic behind it and why it should work. And then I'm going to go through the trading plan step by step. As you can see, it has only 3 steps. So the first step is the bias, right? How can we determine the bias? I'm going to give you a mechanical way to determine the bias. The next thing is, or the second step is the confirmation or the narrative. So how to confirm if our bias is right or it is wrong. And the next thing is the execution. So what are the times of entering trades, right? The time frames and what should we look for. And as you can see here, each step has a corresponding time frame attached to it. So as you can see, the bias, we have these 3 time frames that we're going to operate in. On the confirmation, we have also these 3 time frames, and the execution step has its own time frames. Guys, I tried to make this strategy, this plan, as easy as it can be. All right, I can't simplify it more than this. And finally, I'm going to show you live chart examples. This way, you can enhance your understanding. Now, let's start with the overview of the strategy. Now, suppose we have a higher time frame level. This higher time frame level is an objective for price to reach to it, right? Now, this higher time frame level can be either of 2 things. It can be either external liquidity, so swing highs, or a major swing high, or equal highs, right? Or it can be imbalance, right? Inefficiency, so fair value gap. This higher time frame level will act as a magnet to price to reach for. So let's say we are here, price will do this. It will expand higher and then retrace and then expansion, right? And then retracement, expansion, retracement, and then finally reaching to this level right here. It will not be as simple as this. So during this retracements here, you will see, for example, a lot of manipulation before expanding higher. So here you'll see manipulations, but that is not our concern in this strategy. So as you can see, this retracement is a must. Price will not just explode to the upside and reach this higher time level. It needs to retrace. It needs to retrace. Go to any chart, any trending chart, you will see that there is an expansion and then retracement, expansion, retracement, expansion, retracement, and finally reaching to this level. So our whole strategy is based on this retracement right here. We will capitalize on this retracement. So as you can see, price after each expansion, after breaking external range liquidity, so external range liquidity is swing highs or swing lows, and internal range liquidity are imbalances, in most cases fair value gaps. So after price take external range liquidity, it will retrace to a fair value gap, right? Taking exchange liquidity and then retracing to a fair value gap. And this is our strategy. After price taking external range liquidity, now we will look for that retracement to a fair value gap. That retracement is a must. Price needs to retrace, and then where we're going to look for short setups. So as you can see, it is counter trend, but we're not going to take our entries on the daily time frame. So suppose this is a daily chart. We're going to look for entries on the lower time frames, and it will look like you are trading with the trend. So basically, this is a high overview of our strategy. And now let's start with the steps. We're gonna go through each step one by one and explain it to you guys. So let's move on to the second part of this video. And now let's start with how to determine the bias. So I like to refer to the bias with why. So why should we go to that level, or why should we go down, or why should we go up, right? And as you can see, a simple step we need to follow to determine our bias from external range liquidity to internal range liquidity. And these are the time frames that we want to look for, this external to internal: the weekly time frame, the daily time frame, and the 4-hour time frame. Now you're going to choose only one. So for example, if the weekly is not that clear, you're going to move to daily. If the daily is not that clear, and then you're going to move to the 4-hour chart, right? So let's give you an example. Let's say, for example, we have an expansion to the upside, right? This expansion took some kind of a swing high, right? So a swing high was here, it expanded higher, and we have an objective here to reach. Now, the first step, the first condition is we want to see this expansion, right? If we don't see an expansion, then we don't have a trade idea, and we don't have a bias, and the chart is not clean, right? So the first condition is we want to see expansion taking external liquidity, which is a swing high right here. The second condition is we want to see a fair value gap left on this expansion, right? We want to see a fair value gap. If we don't see a fair value gap right here on this leg right here, then again you're gonna move to another chart or another pair, right? So after taking external liquidity and we have a fair value gap right here, our bias from here is to go lower, right? And this is how we determine the bias, as easy as that. We want to see price expand higher, taking external liquidity. We want to see a fair value gap on that expansion leg. And next, our bias is to go lower. Now, we're not going to short blindly. No, we're going to follow the second step and the third step to confirm our bias and that we have a valid trade idea. So this is a bullish example. A bearish example is practically the same. We want to see an expansion. Lower, right? Leaving a fair value gap right here. And this expansion must take external range liquidity in the form of swing low, right? So breaking external range liquidity in the form of swing low right here. And we want to see again that expansion leg, we want to see it leave a fair value gap behind. So the fair value gap, it will act as a magnet for price to retrace, right? So we have a reason for retracement. So as you can remember, that price will only do two things. It will either seek for liquidity in the form of swing highs or swing lows, or it will balance imbalances in price inefficiencies, areas where price offered only sell side or offered only buy side. So this is how we get the bias. Again, you want to see expansion leg, taking excess liquidity, leaving a fair value gap behind, and that is our bias, either going short or going up in our case right here. And now let's move on to the second step. So after we determine the bias, and now we go to the second step, which is the confirmation or the narrative step, right? Now, the bias is why. So why the price should go is to internal liquidity. And as I told you that after taking external liquidity and expansion, we expect to see retracement to that fair value gap to balance that imbalance. The second step is the narrative, which is how, right? How should price reach to that level? So here we are talking per-year raise, market structure shifts, order blocks, breaker blocks, sweeps on liquidity, right? Change in the state of delivery, turtle soups, these kind of concepts. So as you can see, these are the time frames that we're gonna look for. Now, if we determine the bias from the weekly time frame, it is better to confirm our bias on the 4-hour chart. If we determine the bias on the daily, it's better to use the 1-hour chart. If we determined the bias on the 4-hour, then it's better to use the 15-minute chart. Notice that I am saying it's better. So this is not a static rule, but it is best practice, right? Follow these time frames alignments. So from the weekly to the 4-hour, the daily to the 1-hour, and the 4-hour to the 15-minute, right? Now, what are we going to do on this step? So we want to see a market structure shift. We want to see sweep first. So before a market structure shift, we want to see a sweep on liquidity or an SMT. And we want to see a market maker X model. What do we mean by this? Let's go to the chart and show you. So this is the daily chart, right? And we're going to take this part of this structure right here, and I'm going to zoom into the 1 hour chart. So the 1 hour chart will look something like this, and then reaching for that fair value up, right? This fair value is the same as this, and this structure is 1 hour time frame. So what do we want to see? So what we want to see is a change in the order flow. So as you can see here on the hourly, it was bullish, right? So this move right here. So the structure is shifting from bullish to bearish. So change in the order flow, right? And this is the second step. This would confirm our bias. We want to see a market structure shift, breaking recent swing, opposing swing, and then leaving a fair value gap or a PD array behind it, for example, an order block or a breaker block. Now, I told you here that we want to see a sweep first. What do we mean by a sweep? Before this market structure shift, before this happened, we want to see a recent sweep on liquidity. This will act as high resistance liquidity right here. So this represents high resistance liquidity and price stopped traders that wants to go lower. Now, if we don't see that sweep, for example, price is doing this, right? As you can see, we didn't have that sweep right here. We want to see an SMT. So, for example, if this is the Euro chart, Euro USD, I want to see GBP/USD do something like this. Euro USD and GBP/USD are correlated pairs, meaning they do the same move. So if Euro USD right here failed to take this swing right here, GBP/USD should do the same thing, right? So this is how they move, correlated. But if we see a crack in the correlation right here, so Euro USD couldn't take this swing right here, and GBP/USD did take that swing, that higher swing, it means that we have an SMT divergence, and the market is tipping its hand for us that it will go down, right? So you want to see a sweep. If you don't have a sweep, in this case right here, you want to see an SMT divergence with another pair. If you are using indices, then you can compare US 500 with US 100 and US 30. If you have this structure right here and you don't have a sweep, right? You don't have a sweep and you don't have an SMT, then you don't have a trade idea. You wait for that sweep on liquidity, guys. You wait for these two conditions for one of them to happen. Either a sweep before the market structure shift or an SMT divergence. If you have both, then that's great. For example, if you have a sweep here and the GBP/USD couldn't take that high right here, then it is great. Then it is an extra confluence. Now, the second element of our confirmation step is a market maker X model. What do we mean by that, and why should we look for it? The market maker X model is something like this. So on this curve right here, right, you will see something like this. You will see a consolidation and then expansion to another consolidation and then expansion and then consolidate here. And here we can see, for example, a smart money reversal and then consolidation right here and here. So the market will move like this. So we have a consolidation right here, right? Some kind of manipulation and then expansion higher, consolidation, right? Expansion higher, and here we have that smart money reversal, and we move to the second distribution. So you want to see this kind of pattern, this kind of structure on this curve right here. Now, why do we want to see this? The property of the market maker sell model in our case is low resistance liquidity. Each consolidation right here represents a pool of liquidity. Below each consolidation, there will be a lot of sell stops, and we're going to use that for targets. The market will gravitate toward these consolidations right here. And when I show you chart examples, you will see clearly how these things look like. So let's summarize the second step. I told you that we want to see a market structure shift, right? Market structure shift, displacement to the downside. We want to see sweep and liquidity before the market structure shift, before this displacement. If we do not have that sweep, then we want to see an SMT divergence on another pair, another correlated pair. And then we want to see a market maker X model in the making, right? And that is it. This is the second step. This is all you need to remember. And now let's move to the third step, which is the execution step. And now let's move on to the final step, which is the execution. Here you can see the time frames that we're going to operate in. So the 15-minute, the 5-minute, and the 20-minute. If you're going to use the weekly for buys, then use the 4-hour for confirmation and the 15-minute for execution. And follow along the daily, the 1 hour, the 5-minute, 4 hour, 15-minute, or 3-minute. Again, these are not static rules. You can mess around with the time frames, but these are best practices. So here we're going to add the element of time, right? So we need time in our side here. The time windows we're going to be from 2 a.m. all the way to 5 a.m. and from 8 a.m. all the way to 12 p.m. New York local time. So make sure to use New York local time on TradingView. We want to see a market structure shift from a PD array on the confirmation time frame. What do we mean by that? So let's project this leg right here. So this retracement leg to a PD array on the 1 hour. So on the 1 hour we have a market structure shift. This market structure shift, if it is energetic and we want to see it energetic, it will leave some kind of PD arrays like a fair value gap, right? An order block or breaker block. We want to see retracement to one of the PD arrays and we look for entries on the lower time frames. So I'm going to use this leg right here and project it here on a 5-minute chart. So it will be something like this, right? And here is that PD array on that 1 hour. Again, this is the 5-minute chart. So what we want is we want to see a market structure shift after reaching to that PD array, right? So market structure shift from a PD array. And let's take, for example, that this PD array is fair value gap for the sake of simplicity. So after price retraces to this fair value gap right here, we want to see market structure shift on the lower time frame. Again, we want to see sweep first or SMT. So in our case, we have a sweep and then displacement. If we don't have a sweep for something, if we have something like this, then I want to see an S&P divergence with another pair right here. So another pair did make that new high and then displaced lower. And we want to look for a market maker X model for the sake of targeting. So we're going to target low resistance liquidity again. So for example, here we will see original consolidation right here. And then expansion, consolidation, expansion, consolidation right here. The market will target these consolidations after we hit this fair value gap and we change the order flow on the 5-minute chart. And now let's move on to the most important part, which is chart examples. You will see exactly how to apply these 3 steps and what I have explained on real charts. And now let's move on to examples and with our first example, right? So the first step is we want to see from external liquidity to internal range liquidity. And as you can see here, this is the USD GPY, right? So the US dollar against the Japanese yen. This is the daily chart. We have an expansion higher, right? This expansion higher took external range liquidity in the form of swing high and it left behind fair value gap, right? And imbalance internal range liquidity. So now our first step is gone and now we want to see a move lower, a retracement to that internal range liquidity right here. And now let's move on to the next step, which is the confirmation of that buying side or the narrative. We want to see a market structure shift. We want to see sweep first or an SMT and a market maker X model to target consolidations. So if we move to the 1 hour chart, as you can see, we have a market structure shift. Here on the 4 hour, as you can see, it's bullish, right? And here on the 1 hour, we have displacement lower. We have sweep, right? So we took that high right here. So we have a sweep before that displacement lower. We don't need to look for SMTs here. we look for SMTs in the case of a failed swing, right? So in case this swing right here couldn't take this swing. And now we wait for price to reach to a PD array of that displacement right here. So we have multiple ones. We have this premium fair value gap right here. We have this all consecutive up close candles. This is an order block, and we have this down close candle, which is a breaker block, right? So, and the market maker sell model is represented in here. So as you can see here, we have a consolidation, expansion, consolidation, and then expansion. We will see it better when we go to the lower time frames. So the second step is confirmed, and we have our bearish buys in check, all right? So the next thing is we go to the execution step. We're going to use the 15-minute or the 5-minute or the 3-minute time frame to look for entries. And keep in mind, we have a time window which is from 2 a.m. to 5 a.m. and from 8 a.m. all the way to 12 p.m. New York local time. We want to see a market structure shift from a PD array on the confirmation time frame, right? So if we go to the 15-minute chart, as you can see, the market maker sell model is clear here. So we have a consolidation, right? A lot of liquidity is below this consolidation. We have an expansion, another consolidation, expansion. And as you can see, we have a low resistance liquidity environment right here. This would be our target next. And now we want to see a market structure shift happens from an hourly PD array. So after the price reached that breaker block, right, we have a market structure shift. As you can see here on the 5-minute, we have a market structure shift. We have a sweep first, right? We have sweep before that market structure shift, leaving a fair value gap. You can enter from here, but this is outside our time window, right? So we can wait till the time window arrives. Now you can take entries between these two time windows, but it is better to stick to the kill zones, because when the session starts, it can easily sweep your stop loss and then continue lower. This is why it's better to stick to the time windows. So we have another break of structure right here, of market structure shift, breaking this swing right here. We have a sweep before that, right? And we have an order block right here, a 15-minute order block. We have a fair value gap. You can enter from here, and this aligns with our time window, which is from 8 a.m. all the way to 12 p.m. And as you can see, price melted to the downside, attacking this consolidations right here. So whenever you see this consolidations right here, right, consolidation, expansion, consolidation, and we have low resistance liquidity, you can expect this kind of moves right here. Price just melts down and target this liquidity. Another example, and this is EU, so the euro against US dollar. This is the weekly chart. We have an expansion higher, taking external liquidity, right, and then leaving a fair value gap behind. So the first step is confirmed from external liquidity to internal range liquidity, and this is the weekly. Next, we go, for example, on the 4-hour chart, and we look for a sweep first and then market structure shift. And let's go to the 4-hour chart, and as you can see here, we have that market structure shift breaking this swing right here, and we have a sweep on recent swing high before this displacement. This displacement left a fair value gap behind and an order block. Now we wait for price to retrace to one of these PD arrays, and then we look for entries on the lower time frames. And as you can see here, we have a market maker sell model, and you can see it on the lower time frames as we go in. So here on the 15-minute, you can see we have a consolidation, expansion, consolidation, and then expansion to that 4-hour order block. And now we look for entries. This line right here represents the first time window, which is from 2 a.m. all the way to 5 a.m. And as you can see here, we have sweep on recent swing right here, and then displacing to the lower side, right? Breaking this swing right here, and this could be your entry right here on the fair value gap or the breaker block right here, or this order block right here. You can have 3 PD arrays to enter from. This could be your first entry. Here is the time between the two time windows, right? And here the second time window start, which is from 8 a.m. all the way to 12 p.m. We have a break of structure right here, and then returning to that fair value gap, and this could be your second entry. And as you can see, we have sweep also right here, so this is considered as sweep. If we go to the lower time frames, like for example 3 minute or the 5 minute, you will see this is clearly a sweep before the displacement lower. Another example, and this is the British pound against the Japanese yen, right? So we have an expansion higher, taking this external range liquidity, leaving a fair value gap behind, so internal range liquidity. Now our bias is in check. Now we go to the 15-minute chart, and as you can see here, we have that market maker sell model to target. So consolidation, expansion, consolidation right here, another expansion, consolidation, and then taking that external liquidity. And now what we want to do is to see a market structure shift on the 15-minute chart. As you can see, we have that here, right? And this is the London kill zone from 2 a.m. all the way to 5 a.m. We have a break of structure. As you can see here, we don't have that clear sweep on liquidity, so maybe you can consider this as a sweep on liquidity, and it is valid. But if we go to the Euro GPY chart, so Euro GPY is the correlated pair with this, you can see that this swing right here, right, on Euro GPY violated this swing right here. So we have an SMT divergence on this pair right here. So here this could be your entry, or you can go even lower on the lower time frames, and you will find that third entry here, for example, on the 5-minute chart or the 3-minute chart, and this could be your entry, right? Targeting all this consolidation right here and low resistance liquidity. We have another entry on the New York kill zone, right? From 8 a.m. all the way to 12 p.m. We have the sweep on liquidity. We have a break of such displacement lower, and this could be your entry right here, targeting this final consolidation. This is called original consolidation. Another example here, this is the euro against the US dollar, so EU. We have displacement to the upside, taking external range liquidity. Our next target is this fair value gap right here, alright? So we have our bias. Now we go to confirm it on the lower time frames, and we have here the 1-hour chart. So as you can see here, we have that market maker sell model in the making. We have this buy side of the curve. We have the original consolidation right here, expansion, consolidation, and then expansion, right? Taking that external liquidity. And now we wait for a market structure shift. So we have that here, right? We took this swing right here. We have the sweep before that market structure shift. And now we wait for retracement to one of the PD arrays of this displacement. And as you can see here, we have this unicorn model. So when you see a breaker block inside a fair value gap, or a fair value gap inside a breaker block, there is a high probability that price will retrace from here, leaving this fair value gaps open, right? So after price retraces to this breaker block right here, we can go to the lower time frames and we look for entries. Here is the 5-minute chart. Price retraces to that breaker block, and we have sweep on liquidity, and then a break of structure displacement to the lower. This could be your first entry right here on the order block, right? And we have another displacement to the downside, leaving a fair value gap behind. This could be your second entry, and as you can see here, we are on the second time window, 8 a.m. to 12 p.m. and you can target all this consolidation side here. So this is the 15-minute chart. You can see that here we have a market maker sell model inside a market maker sell model, right? So here's the first one, and we have another one on the 15-minute chart, right? Price will gravitate toward this consolidation right here to take liquidity. And with our final example on this video, we have the euro against the Canadian dollar chart. This is the daily chart. We have the expansion higher, taking external range liquidity, leaving a fair value gap behind, a small one, right? And on the 1-hour time frame, this market maker sell model in the making, consolidation, expansion, consolidation, and then expansion. Now we wait for market structure shift. As you can see, the 1-hour chart is bullish. Now we want to see it go to bearish. So here we have a market structure shift, right? Displacement to the lower. We have a sweep on liquidity first, right? Before that market structure shift happened. and we have a breaker block right here on a mitigation block. So on this curve right here, on this buy program, this was an order block, right? Price found support on this order block and continue to the upside. On this curve right here, now on the sell program, this would become a mitigation block. So when price violates it, it will act as resistance, right? So I was expecting a deeper retracement to here, to this fair value gap, and then look for lower time frame entries. We didn't get that, and we also price found resistance on this mitigation block, right? As you can see here on the 15-minute chart, found support from here, and as you can see, price again melted to the downside. Now I noticed that I only gave you bearish examples. I didn't give you bullish examples, but take it as an assignment and you can go to your charts and collect examples both bearish and bullish. And whenever you see an expansion higher or lower to take external liquidity and leaving fair value gap behind, I want you to follow these steps. So you go to the confirming the buys and then the execution and look for this kind of moves right here, right? So I believe we have come to the end of this video. It was kind of a long one because of all the examples. So if you have any questions, please DM me on my Twitter account or leave a comment down below and I'll answer you as soon as I can. Happy trading and good luck.